Did you know that it's an index fund that will make you 3 times what the Nasdaq's going to make when it goes up? You're thinking to yourself, that's a great investment. And yes, you might be right or you might not be. We're going to go over that investment, the pros and cons, and more importantly, if that's an investment that you should consider as you grow your wealth. Before we get started, as always, like, subscribe, and share to our channel. In real life, I'm a certified financial planner, blessed to help thousands of people worldwide. But on these social media airways, what is given information? This information is keen to help you scale your finances. You're ready to talk about this index fund that's going crazy right now? Lego.
And you just wanna get paid, tired of making the money mistakes. Make a payment on your bills and you still late, yeah. Painful profits to help you seek change, and you just wanna get paid, yeah. Tired of making the money mistakes. Make a payment on your bills and you still late, painful profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Been check to check, you know, and it could be different.
And the index fund that we're talking about is symbol TQQQ. Now, we all know or heard of symbol QQQ, and that is the index fund tied to the Nasdaq done by Invesco QQQ. Would invest in all things Nasdaq, which is basically all things tech. But on the more aggressive side of the spectrum, you have symbol TQQQ, which is the aggressive version of this investment. It's really ultra aggressive. The reason why, because it is supposed to give you 3 times the return of QQQ. So theoretically speaking, if QQQ or the Nasdaq goes up by 1%, this investment makes you 3%. If the Nasdaq goes up by 10%, then this investment will make you 30%. So it's great because we get a lot of the gains if QQQ goes up. On the flip side, it's downturn as well. And that downturn is when the market goes down. Also, TQQQ goes down 3 times as much as well. So QQQ goes down by 1%. QQQ goes down by 10%. TQQQ goes down by 30%. So is it really a good investment? It depends on your time frame, your risk tolerance, and if you can stomach the good times, but more importantly, the bad. So we're going to go over the actual intricacies of this investment and why for some it's a good investment and for some others it might not be. Well, let's first go to QQQ, which has done an incredible job compared to where it was back in April, right? A month and a half ago, we felt kind of iffy about the market, but now it's up 19.1%. If I had $100,000, I made $19,000 this year, right? On average, the Nasdaq the past 10 years has averaged 12%. So if it does not do anything else the rest of the year, even though we have half a year left, it, my friends, is going to give you a above average return. So great. Now, this is an index fund, right? QQQ is tied to the Nasdaq 100. Tied to the Nasdaq 100 means the top 100 companies in America on the Nasdaq, which are, and if we just look at the top 10 holdings, right, 8.5% Nvidia. So by holding this index fund for every $100,000, $8,500 is in Nvidia. Then we have another 7% that's in Apple that just hit an all-time high. Microsoft, 5%, that is still underperforming, a stock that we think will do incredible by the end of the year. Not a recommendation, just information. Amazon, they hit an all-time high at 4.6%. Google hit an all-time high, 3.6, right? Google A and B. Micron has been incredible this year, 3.8%. Broadcom, another all-time high. Tesla, some people love Tesla, some people hate Tesla. I think Tesla has the opportunity to grow crazy, especially when SpaceX becomes public, and then also Meta at 3.1%. So your names. The names that people love, a lot of Mag 7 names in there, right? Names that we love. So what if we had the opportunity to get these same names in the same index fund style, but then when it goes up by 19%, we make 3 times as much? That, my friends, is TQQQ. And if we can look here, remember 19.1% for QQQ. Now we look at TQQQ, up by 56%. right? 19 times 3, 56%. Wow. Business owners, this one's for you. You see, you're working hard every single day. But here's the real question. Is your money working as hard as you are? I'm running a webinar, and it's built for business owners like you who want to grow, who want to learn how to do real estate deals with no money out their pocket, how to invest with intention, and how to structure the business so it exactly builds wealth instead of just keeping you busy. So the goal is simple. Let's build income that keeps moving even when you're not. So the work you do today is still paying you tomorrow. This isn't theory. It's a roadmap for people who are serious about doing more and keeping more. Now, spots are limited, so click here or here. We hope to see you during our webinar. Now back to the episode. Wow, wow, wow. Now the drop, of course, was a lot lower. And that's what happens when we'll talk about the risk and reward. But I'm able to get those same names and the same fund. And if I'm long-term, looking at something that's long-term out, then 3 times my benchmark, pretty good invested in the same names, theoretically speaking. Now, with some internal things that go on that makes it 3x, i.e. options, which we'll talk about, but just on the surface, all things being equal, you get 3 times as much. So people might say that from a long-term standpoint, it's not a long-term play. Well, let's look at last 5 years. Last 5 years, up by 219%. $100,000, $400,000 later, I'm a happy person. Now let's compare this to the index of QQQ, because the thought process is this is not a long-term investment because of the options and the swaps. Well, if you look at QQQ, past 5 years, 118%, right? So long-term did not make you that 3 times as much, because you would think if I have 118% times 3, that should be closer to what? About 360%, not 219. So long-term did not give you the 3 times as much, but it still did better, doubling it. So that is the good. It gives you an opportunity short-term and long-term to outperform. Now, past performance does not guarantee future results, but it does give you the opportunity, long-term, theoretically speaking, to outperform your index. Is it just me? Or is that you're working hard, but you're not seeing the financial results that you want? We're clocking in, we're clocking out, we have the income, we're making the money, but our wealth is not growing like we want it to. Well, my friends, it's not your fault. You know why? Because we're never taught how money works. We're taught how to spend it, but we're not taught how to leverage the money that we're making right now to build wealth. Now, wealth, it comes in all different shapes and sizes. The question is, how much wealth do you want for you and your family? But the best part about it is help us on the way. Join us during our 5-day mentorship, where you learn how to structure your money, reduce your tax liability, increase your net worth, and build wealth. We'll show you how to go from a wealth builder to a wealth strategist to a wealth creator, and leaving that long-lasting legacy to your family. Click the link below and join us on our 5-day mentorship, where we'll help you accelerate your wealth. Now back to the episode. However, where the bread is buttered, where the money is made, where the gumbo is created, is not during the good times, it's during the down times. Because our stomach of making money, when we have euphoria, is great. But our stomach, when it comes to losing money, that, my friends, makes us or breaks us from an investment standpoint. Look at the chart. Well, let's first look at QQQ, because again, things are great when they're great. When they're not great is when we get into trouble. And we look at top to bottom, right? From January 2022 to December 2022, we all remember 2022, from top to bottom, we were down by 36%. If you include late 2021, it actually went down by 40%. 40%, you guys, that hurt. So if QQQ went down by 40%, what do you think TQQ did? Well, let's look at here. TQQQ. Remember, when it goes down by a lot worse. Look at here, my friends, right? From top to bottom, show this out, from top to bottom, it went down by 82%. So not down by 3 times as much, because down by 36%, 3 times by much is basically 100. But how would it feel to be down by 82%? So when things are going up, it's great. But the question is, would you rather lose 36% or lose 82%. Now, of course, we don't want to lose anything, right? But the bad thing about TQQQ is when things go down, you go down as well. And from a psychology standpoint, are you like the 83% of Americans who want to get a trust, who want to get a will, want to get a power of attorney, but you don't have one? Well, you are not alone, because 22% of Americans have one. That means 1 out of every 4 families have a trust, a will, and a power of attorney. Which bracket are you in? 1 out of 4 or 3 out of 4? It's okay, because we have the Relax Estate, a fully automated AI platform that allows you to create a trust, a will, and a power of attorney all at the fingertips. And if you are an insurance agent, tax professional, financial advisor, notary, or in any business profession, you can even white label this to your clients. You grow your business, you help your clients, everybody wins. Visit our website, www.therelaxestate.com. Right here, therelaxestate.com, and you can create a trust for your family, or if you're a business owner, want to use it to scale your business and help your clients, you can do that as well. Now back to this wonderful episode. Most investors, they sell and they wait till it gets back, or they wait till it gets at an all-time high and they have the FOMO, the fear of missing out, instead of holding or buying as it goes down. Another prime example, QQQ. This year, right, when things were kind of shaky after the war, right? Which the war is still going on, but you know what I mean. Down by 12%. That's kind of hard to see, but down by 12%, right? Down by 12%. 100 grand, I lost $12,000. You know, not as bad as 36%, but still, right, being down by 12% is kind of hard to stomach, right? Because when things are going down, it's like, will it ever stop? That's when we have capitulation. I just sell it all. I'll just worry about it later. Well, if we look at TQQQ, even worse, because that same time frame, not the up part, but the down part, down by 40%. Right? QQQ down by 12. So times 3 is 36. This went down by 40. So ouch. Being down by 40%, that's capitulation. So the not so good part about TQQQ is that when the market goes down, you have to stomach that loss. You have to stomach it going down, thinking and knowing, now past performance does not guarantee future results, that eventually it's going to recover. We just don't know what that eventually is. But we can clearly see TQQQ, and we can clearly see that from its bottom, March 1st, to today, it's reaching an all-time high. It's up by 120%. 3 months, you guys. March, April, May. 118%. Now, who is buying things at its bottom? Not a lot of people. Heck, I didn't even. And I own this. So yes, it's good to look for illustration purposes. Realistically though, if you're up by 80%, who's mad? Up by 50%. It's up by 54% for the year. Who's mad? But from a risk tolerance standpoint, you need to have a aggressive outlook. You need to have predefined roles. You need to have predefined outcomes. And once those outcomes hit, have something set in stone what you're going to do about it. If our predefined outcome is holding, then we need to hold. If our predetermined outcome is buying once it hits a certain number percentage-wise, once it goes down by 10%, 20%, 30%, or my cliff dip bear strategy, you buy 25% of that stock when it's going down by 5%. You buy another 25% when it's down by 10%. You buy another 25% when it's down by 20%. And then after that, we just dollar cost average. It'll go up eventually. Past performance doesn't guarantee future results, but indexes do recover over time. That's having a predefined outcome. Now we combine that 118% increase over the same time period with QQQ. So QQQ, same time period, right? From its bottom, March 2nd, up by 31%. Now again, who do we know that bought at the bottom of March 2nd? Most hedge funds, maybe nobody, to be honest with you. Maybe a few people, but mostly nobody. They use the illustration if you bought at the bottom, but nobody does, right? So let's say you're up now by 20% from the bottom. We're all happy with that still. But compare that to buying at the bottom with TQQQ, and you're up by 118%, not 31%. We'd rather be up by 31% or 118%. Now, we would never, ever, ever want to see something fall by 40% or by 80% like TQQQ. But it goes to show, if you have the stomach from a risk standpoint, investing in the index, investing in Tesla, Microsoft, Nvidia, Apple, Google, Amazon, Facebook, just like the index. It gives you the opportunity and the ability to take advantage of those stocks, but have some juice as it goes up. Why is it giving you 3 times the return of the index? That's the real issue. And that's something that you have to understand before you make an investment decision. Here's the reason why. Because they use financial derivatives instead of stocks. So they're not actually buying the actual stocks per se of that index, like Meta and Nvidia and Facebook and Tesla and Google. They're actually buying derivatives, which are basically options, right? And they're swapping them with future contracts. So they have a goal, and through financial engineering or through mechanics of finances, they get you that 3x return, right? So swap agreements, TQQ signs contracts with major investment banks. So everybody's in on this, y'all. And the bank agrees to pay TQQ the exact daily return of the Nasdaq multiplied in the contract amount. In exchange, TQQ pays the bank a short-term interest rate, like a fee. So at the end of each day, we know how much the index made, the QQQ, the Nasdaq. Let's say it made 1%. Well, the investment banks, Goldman Sachs, Morgan Stanley, the investment banks, they pay TQQQ and make sure that the performance is exactly that. If QQQ goes up by 1%, then they make sure that the return is 3%. Because it does 3 times as much. Now, because you're giving me that clarity, Mr. Investment Bank, me, TQQQ, I'm going to pay you, investment bank, a fee. So every day I'm paying you a fee to make sure that I'm always 3 times the index. Index goes up by 1, I'm now at 3. Index goes up by 2, I'm now at 6. Index goes up by 3, I'm now at 9. Index goes down by 1, I'm now at -3. So yes, short term, that's why people say it's a good investment. If you believe the market's going up, check your risk tolerance. Long term, the reason people say that is not a good buy and hold strategy is because over time, those fees that you're paying the investment banks add up. That's why over 5 years, it didn't do 3 times as good as the index. It did 2 times as good as the index. But over a short-term time period, which is so far this year, it's done 3 times as the index. And so, yes, with compounding interest, those small fees here or there breaks into our performance. So that's why long-term, you don't ever get the 3 times return that you expect, because those small fees that TQQ as a company is paying those investment banks are adding up. And guess who foots the bill? The company doesn't, you, the investor. So the question is, even though we're paying those small fees, is it worth the risk for the reward? Well, before we answer that question, we also have to understand a thing called time decay, right? And time decay is the longer that we have something, the more our money goes down. Decay. A great illustration, because it's 3x multiplier applies only on a day-to-day basis. Over time, that time decay, like I talked about, or those small fees they pay to the banks add up, right? So that's why over time, it never exactly gets to that 3x, right? Join us in our school community as we have modules, classes, courses to go from a taxpayer to a wealth builder. How to use our cliff, dip, bear strategy to do better with your investments. How to acquire businesses and how to use your retirement plan to grow and not pay taxes. What? I can have our retirement plan grow and not pay taxes? Yes, your IRA or even your 401k at your employer. This and other things we focus on in our school community, the Relaxed Investor. And guess what? You get 7 days, free access, and you get our weekly coaching calls every Wednesday. You and hundreds of people ask questions to 6, 7, 8, and even 9-figure business owners that tell you how they created their business, how they run their business, and how their finances is as smooth as it can be. So click the link below and join us in our Relaxed Investor Academy to help you scale your finances. So day 1, $100, $100. Day 2, up by 10%, 30%. But now day 3, right? Now it's not 3x or 10% or 30. Now it's 9.09. It goes down. So as it goes down, I'm not down by 30%. Now I'm down by 27.27. So now the value is 94.5. So as shown, Because of this imperfect system, TQQ has lost 5.4% of its value due to the compounding loss of the smaller asset base. Because with compounding interest, right, the more that we have, the more that we make. But when it goes down, the less that we have, the less that we make, right? If I got $100, I lose 10%. If I lose 10% going down, that's $90. In order for me to be back at 100, is not 10% because 10% of $90 is $99. I need to make 10.5%. So because of that time decay and compounding interest, as I said before, when it goes down, it has to make more to get back to where it was. That's why we recommend people never to spend their money, right? You could say, oh, yeah, I made $100,000. I'm going to take it out. I'm going to make it back. Yes, but it's going to take you longer to make it back. If I got 400,000, I take out, now I got 300,000. I do not need it to make that 33%. I needed to make more because I'm digging out of a hole. It takes more money percentage-wise to make back the money that you lost. So because of time decay and those small little fees you pay on a month-to-month basis, it takes longer for you to make that money back. And that's why people say from a long-term standpoint, it's not worth it. But the question's for you. The ball's in your court. Not a right or wrong answer. If you want to have the ability to be in an index, but do 3 times the index, short term and over time more, then TQQ might be a good investment. Again, I can't make any recommendations because I'm a fiduciary. I'm not a person online just giving information and you don't know what's going to happen. I'm a fiduciary. I get in trouble if I get it wrong. So this is information, not a recommendation. My clients, yes, they do have TQQ. Do they have all their money in TQQQ? No. They have a small amount because of diversification? Yes. For you, you need to do your own research. From a strategy standpoint, we typically like to use TQQ in the bull market. So when the fear and greed index, theoretically speaking, is at extreme fear, where all hell looks like it's breaking loose, that's when you might want to look into TQQQ because it's a possibility from there the market's going to bounce up. Does that possibly mean a month or 6 months from now? Nobody knows but God the future. But with that extreme fear of people having capitulation and selling, that's might be when we want to buy it. When the market's at its all-time high, might not want to buy. We actually might want to sell down and sell from TQQQ to QQQ, which we have been doing for clients the last month. Yes, it's continued all-time highs, but we want to make sure that we pocket our gains, not chase our losses. Again, phrase of the day, pocket our gains, not chase our losses. And that's by selling things at a high. And then when things go back down again, close to that capitulation, being down by 5, 10, 15, 20%, then we look into entering that position. In this case, we're talking about TQQQ. So, do you take advantage of an index fund, hypothetically speaking, index fund that does 3 times better short term than the market, or do you stay away? Will your risk, your assets, your diversification, how it's going to feel if it goes up or down, and more important, your time horizon, how long do you have, will make that decision. I know one thing, if you do have the opportunity to be in an index fund and make more in that index fund, you might want to do your research before you do it because it could be great or not so great. That's why we always say love is love because we love it. And those profits can be painful when it goes down, but it's still profits if you hold it to the upside. So let me know your thoughts. Are you in TQQQ? Are you out of TQQQ? Would you rather hold the index? Would you rather hold TQQ for the long term? Let me know your thoughts. And like I said, past performance does not guarantee future results. I'm just giving information, not a recommendation, because I'm a certified financial planner and I got stuff to lose telling y'all what to do when I'm not your certified financial planner. But for you to gain is knowledge and research that's going to make you a better investor. And prayerfully, that's what we're doing with this channel. So like, subscribe, share. We have 100,000 followers. Thank you guys so much. Continue to like, subscribe, share, send me a hype so I get boosted into the algorithm because people need to know how to make money, but also how to make sure from a risk standpoint, they're doing things properly, and prayerfully we'll continue to get information. As always, let's make some painful profits together, y'all. Peace.